Yo, what is going on, guys? Welcome to another video. You guys already know what time it is. There's a lot to get into, so let's just go ahead and get right into the video. So last week was an absolute bloodbath. As a matter of fact, these last 2 weeks have been extremely rough for the market. It's been it's been rough, it's been horrible. But so obviously you have inflation still continuing to be an issue, and we saw this firsthand last week as the Federal Reserve's preferred benchmark for consumer inflation was released last Friday, and it wasn't good. So the personal consumption expenditures price index, otherwise known as the PCE, came in hotter than expected at both the core and headline reading. And unfortunately, this slight uptick was not what investors wanted to see. And so not only are we still dealing with sticky inflation, but you've also got a ton of different macroeconomic issues all over the world. We're dealing with rising interest rates, obviously, from the Federal Reserve, slowing economic growth. You've got central bank issues going on with the United Kingdom. And then obviously we still have the Russia/Ukraine war that is going on. And it does appear to be escalating to the point where, I hate to say it, but there is a slight possibility that it could get nuclear. And that would be bad for everybody. If that happens, none of this finance stuff matters. All that matters is protecting your freaking life at that point. But hopefully that doesn't happen, although it appears that there is a very slim chance, which is still pretty scary. Now, on top of that, last week, we also got one of the most important earnings that came from Nike. Reason why is because Nike for the past 2 years has said that it didn't have enough inventory in order to meet customer demand. Now the complete opposite is happening. Now they're saying that they have too much inventory and that they might even have to step up and start giving out discounts in order to clear out those items. Now, because the Fed remains committed to bringing down inflation, and we've seen this, we literally had 22 different Fed speakers speak last week, and they were all very hawkish. They were not playing any games with investors, and the stock market responded, and the stock market didn't like that. Now, consumers are less likely to acquire discretionary goods like shoes and clothes. We're talking about the Nike earnings here. And that's part of the reason why you're starting to see some of the issues happening with Nike. And that all adds into this entire thing of the macroeconomic picture, the Fed raising interest rates, inflation going on, and all those different things. So just painting the picture for you guys of what exactly is happening here. Now, looking on to next week, there's really not much to watch out for except for the jobs report. This actually comes out on Friday. Now, what investors want to see is the number going lower, as that would show that the Fed's aggressiveness is working and the labor market is slowing down, which is what the Fed eventually wants to see. They even said it. Now, let me show you guys exactly how bearish everyone is. Okay. So there's this survey that came out by the American Association of Individual Investors, and it showed that 60% of retail investors hold a bearish view of the stock market. This is the highest level seen since 2008. And this is also the 8th most pessimistic reading in the 35 years since the survey has been conducted. Now, you guys remember, I've been telling you guys this, all these different data points and different things like that are being compared to 2008 and the tech bubble in the 2000s. That's not a coincidence. There's a reason why this period we're in is being compared to those other two periods where we saw really nasty bear markets. It's because the situation that we're in, we are going to see a really nasty bear market. And in terms of just the overall economy, things look bad. There's no other way around it. Now, here is some good news. I am going to shine some light here. I'm not saying that I'd be loading the boat on stocks here, but I just want to point this out. I did see this article. I believe this article was in Forbes. It says right here, since 1950, there have been 18 midterm election cycles. And in the 12 months following each and every single one of those midterm election cycles, the stock market has had positive returns. Now, U.S. stocks have consistently earned positive returns after previous midterms and delivered average annual returns of 18.6% compared to the 10.6% in all other years. Now, if people ask why exactly I think it's very simple. You guys know I used to work in politics. I think it's because it means less legislative risk. I think that's honestly what that means. Typically, the stock market likes it when you've got both parties in there and there's this thing called gridlock happening. Typically, the market don't like it when one party just has full control of everything and they're just easily able to pass whatever laws that they want. The market likes it better when you just got the Republicans and the Democrats fighting and they can't get anything passed because, capitalism and money, folks. The Wall Street wants things to stay the same. They don't want to get taxed like crazy and all these new proposals that the Democrats are proposing, all that. They don't want that. So There is actually an argument that if the Republicans win the midterms and take back either the House or the Senate, whichever one, there is an argument that that actually would boost investor sentiment. And the reason why is because that would create less macro uncertainty. Okay, now I wanted to show you guys something else. Again, we're just ending on a positive note here, and I also am showing you guys something that is 100% true. So here's a chart right here. It shows the S&P 500's returns after falling 20% from all-time highs. So if we go ahead and we actually look at this chart right here, you can see that on average, well, let's read the chart fully. So you can see the purplish bar is a 6-month return. The blue is the 1 year. The other blue is 2 year. The light blue is 3 years. Okay. From left to right. So we're just looking at the average all the way to the right. You can see that on average, whenever the S&P 500 falls 20% from record high, the returns you get after 6 months is about 6%. It looks like, from me reading on this chart. It looks like after 1 year, you can expect about a 12 to 13% return. After 2 years, you can expect about a 23% return. And then after 3 years, you can expect about a 27, 28, almost a 30% return. That's on average. Now, so the gist of what I'm trying to say is, you know, obviously things are going to be more bearish. I have no doubt about that. I have no doubt that the market is going to go lower, but I'm still buying the dip. I'm still buying stocks. I mean, the market is just falling so much. We're in a bear market. I'm at the point now where I'm just putting my head down, ignoring the noise, and I'm buying. Now, in terms of paying attention to the news, stuff like that, of course you want to pay attention, but don't let that stop you from buying. Don't be fearful. Don't try to catch the bottom. We're already super duper low. Buy the S&P 500 and chill. That's all I got to say. Not financial advice. Okay, guys, that'll go ahead and conclude today's. Okay, guys, that will go ahead and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe, and I'll see you guys in the next one.